Hello, everybody. Thank you for taking the time to listen on our call it Labor Day pro America version of Market Pulse, and ironically titled today, Sell America. And that's what we're going to
hmm
talk about today. I'm here with Bepin as always. And to get started today, we've got a great quote from one of the best authors, one of the most quotable authors of all time. The rumors of my demise are greatly exaggerated. I love that one for so many reasons, and we're going to talk about what has been, in our opinion, also greatly exaggerated today, and that is the demise, the downfall of the greatest nation in the history of mankind, and that is the United
This
States of America.
the Sell America trade.
The Sell America trade. That's all we've been hearing about nonstop. Either it's been a lack of news cycle, or the fact that this was something that was really scaring some people. Ironically, while we were hitting all-time highs along the way in the market, but I've seen, I don't know, Bepin, how many, daily almost for, I
Uh,
don't know how long, a month and a half, 2 months at this point?
if you read the Wall Street Journal, yeah, it's probably at least 2, 3 times a week you're going to hear some article saying that a lot of people are moving out of American assets, and we just haven't really seen that example play out. But
Yeah. Yeah, I wonder if this all started with the whole, well, not just with tariffs, but the dollar weakening. I mean, we start
yeah,
seeing these news cycles all the time where foreigners, this idea that foreigners own all of our debt and they're going to
yep,
be selling it. And we've talked about this before, Bevin.
yeah. I
I'll
think
give
on
you
our
some.
last presentation, yep.
Yeah, what a third of our debt, of our government debts, not even a third, is owned
hmm
outside the U.S. Our largest foreign owner of our debt is not China, it's Japan
No,
at like
Japan, yeah.
7%. 7%. So China's a little bit less than that. So the irony is that two-thirds of the national of our government debt is owned by us, the United States of America, government agencies, government company, U.S. companies, and
Yep.
U.S. citizens. So let's push that aside for a second and let's go to the data. That's what we do here. All right. We were very skeptical when we heard these rumors and all the news cycle. So we wanted to check the data because that doesn't lie usually. And if you look
hmm
at the data tells us the exact opposite, literally the exact opposite of what's going on in these headlines right now. Okay. So this is kind of a quirky chart. We're going to walk through it. I
hmm
love this chart. So this is showing, going back to the beginning of April, what it's showing is the direction of the 10-year treasury, okay? The rate on the 10-year treasury, okay, the yield. The green line is showing how that treasury yield moved on a daily basis during market trading hours or New York trading hours, okay? So New York hours being East Coast time, okay?
Yep.
So when we're all up and running and doing our thing throughout the day, taking the kids to school, having a bite to eat at lunch, all that, that green line is showing you what was happening in the treasury yield, okay? The 10-year
hmm
treasury yield. Now, the blue line below it, all right? The blue line is what's happening when we're all asleep, okay? The after hours. The reason why we're showing that blue line is that after hours index, or that after hour move, is indicative of what's happening with foreign buyers and sellers of the US Treasury bond, okay, the 10-year Treasury. Now, again, because rates move inverse to price, if those
hmm
lines go up, that means people are selling. If the lines are going down, they are buying. I think this is a very fascinating phenomenon, Bepin. During market hours, that green line has been, for all intents and purposes, rising for several months, which I think might be fueling the cycle, saying, okay, wait a minute, the 10-year Treasury yield is rising, so therefore we got a problem. It's a sell America trade. But guess who was buying when Americans were selling? Foreigners. We know that now.
Ironically, I,
Ironically, super ironic.
I
The
know.
blue line's
Ironic.
going down.
I think we were the only ones getting the Sell America articles. I don't know if the Europeans and Asians were also getting the headline saying Sell America, but we were seeing them here at home.
This is what's happening. So I find it to be very ironic. Now, I think the obvious next question is, with the data here, Beth, and it's like, why would foreigners be buying when we're tariffing them? Why would they be buying when the dollar is weakening? And why would they be? I could give you all these million reasons, questions. Why? We don't know for sure, but I think there's a couple things that might make sense. Bethany, where are target interest rates in the U.S. today versus Europe?
Much higher.
Much higher, much
Yep.
higher. Yeah. So if
Higher
I'm a
yield.
foreign investor and I say, hey, wait a minute, I don't really want to. If I'm in Europe, for example, I don't really want to collect whatever it is, 2.5% right now, depending upon what you're looking at. I would much rather collect 4.5 or whatever it be in the United States, whatever that spread is. That might make sense, right? So there are some very strong financial regions, aside from the fact that our economic engine is like no other in the known universe. Okay, so there are some reasons why they might be coming over here. Furthermore, every time somebody here in the United States sells and causes that yield to go higher, guess what? To that foreign investor, that starts to look way more attractive. So what's happening, I think what's happening at least, is that as domestic owners of America, who was selling America, like you said, Bepin, America was selling America. And guess who was buying it? Not America. Amazing. Amazing.
They weren't just buying bonds either.
Oh, no, no. Oh, no, no. This is a good point, Bepin. I'm glad this chart's up on the screen here. It was kind of a rebound for U.S. assets, not just bonds, not just government bonds, but assets that are domiciled here in the United States. This is a busy chart. On the far left-hand side, you see that word total at the bottom. These are total U.S. assets. And as you can see, on a month-to-month basis, okay, from left to right, it goes from January to June effectively. And as you can see here, if it's above the zero, that means there's a net positive demand. And if it's below zero, it's a negative. Okay, so simple example, that big red bar under the total section, that's May of 2025. Okay, that means in May of 2025 there was a massive rebound and strong demand in foreign ownership of U.S. assets. So the point here is, if you get more granular, like you said, Beth, if you look at not just treasury bonds, but equities, corporate bonds, and go on and on and on, of these major asset classes, the trend is really consistent across the board. There's been a positive net demand for not every one of them, but most U.S. based assets.
Yeah, exactly. For the points I think you made earlier, are just one of the best economic engines on earth. I know that international stocks and emerging market stocks have had a very good year this year, but that's almost been a product of underperformance for the last decade. U.S. stocks or U.S. companies have driven the future that we live in today. It's been Apple, Google, Microsoft. Not many coming out of Europe and Asia.
Wine and cheese, that's what you get out of Europe, which are important. Don't get me wrong.
Very.
They're very important, but they are not going to transform the world.
And obviously, we can't ignore the elephant in the room. So since the last we've recorded, there's been some updates regarding the Fed. Obviously, they've been kind of in the crosshairs the whole year. Earlier this year, I think we saw the administration come after Powell over, what was it, cost overruns on the 3 new buildings they were making, or a couple buildings that they were renovating for the Fed. I think it went a couple $1 billion over the estimated budget. And at one point, it was believed that he was going to fire Powell. Of course, that all cooled off. But there's been some updates since then. The first of which being the first red X you see on your screen there. Just to break down what the chart you're looking at, these are the 11 voting members. Oh, sorry, the 12 voting members of the FOMC, the Federal Open Market Committee. These are the guys that are, like, ladies and gentlemen, that vote on rate decisions for the U.S. government. They are the deciders of interest levels. And currently, obviously, we've seen them hold throughout the majority of this year. But obviously, the Trump administration has been very vocal in saying that they want cuts. And the most recent update here has been the controversy around the Board of Governors member, Lisa Cook, over to the left there. Right now, her situation is kind of up in the air. They have fired her, or they've released an executive order firing her. She has challenged that. This will likely be a court case for quite a while. The reason for her firing seems to be quite minor. In my opinion, it seems pretty minor with the mortgage fraud. Now, obviously, what she did would be considered a crime. One thing that a lot of people have noticed is she hasn't denied doing it, which leads you to believe that she probably did it. Now, is this cause for firing? That's where the debate really begins. A lot of the Trump admin and the Trump supporters believe that, yes, that is cause for firing. She broke the law. She should be fired. There's obviously standards in her job. I'm sure there's something written in there that if you break the law of any sort, that is cause for removal, or at least cause to be censored in some sort. Now, what a lot of people are looking at this as is the Fed could potentially be losing its independence. Now, we don't know why Adriana Kugler resigned earlier this year, but I mean, my guess would probably be that she saw kind of the storm that's coming. And guess what? Federal or government employees don't get paid that well. All of these people on your screen right now are taking a pay cut to be on the Fed board. They would all be earning substantially more in the private sector, whether it be in educational roles or whether it be at bank roles. They'd be earning multiples of what they're earning right now. The risk to this is if the market starts believing that the Fed is no longer independent, they will start pricing that in. And how do they price that in? They're going to price in runaway inflation, because their thoughts are going to be that, well, the government's going to be able to control spending, and then they're also going to be able to control the monetary side. And if they're able to control both ends, fiscal and monetary, guess what politicians like to do? More often than not, they like to spend. And guess what they need to spend to continue to keep spending? They need low rates. But what does that do to inflation? What does that do to the value of our dollar? As we saw in 2022, not very, it doesn't do very good things. What it typically leads to is high inflation. We saw inflation almost get up to 10% during that 2022 cycle. So that is currently the fear. Now, I'm on the opinion that this could be seen as a little bit political. I mean, they're clearly going on a fishing expedition on every single person you see on your screen, besides probably the two you got that green check mark in. The reason they have that green check mark is, A, they were either Trump appointees, or two, they also voted for rate cuts at the last meeting. They were the two dissenters, or Waller and Bowman. Now, I know Mike has a different opinion on this. He believes that this is very justified. It's a very justified.
Well, I would say just look, let's focus on the market versus what's right or wrong. And I think that's where my issue is. I've got two kind of points around this. One is, if people really think that the Fed is independent, if they really feel like the market truly feels like the Fed is losing its independence, then I think this is probably the same cohort that actually thinks the Supreme Court is independent as well. I mean, there's no way you can have an independent organization in a government. I would go back to saying, I'll give you an example at this current Federal Reserve Administration. Now, different voting members back then, but back in 2021, the number one risk facing U.S. companies and the U.S. economy, the number one risk published by the Fed, climate change. Not runaway inflation,
make a case
not
for that.
printing. There might look, we're talking about, maybe down the road. I'm not getting into that. My point though is that is a clear indication of some political preferences within the organization. I'm not saying they're right or wrong. I'm saying that they're there. Okay, that's one thing. I think the market is way too smart to realize what's going on, and I think that they don't actually believe for a second that there's pure independence in the Fed, which is why we haven't really seen much reaction except for in the media, the news cycle, because they love this. But here's the thing about the Fed and the government. The media is acting like this has never happened before. But I got a story for you, Bepin. 60 years ago, okay? 60 years ago, President Lyndon Johnson, famously clashed with the Fed chair at the time. His name was William McChesney Martin. So LBJ was people don't realize he was a very tough guy. Like, he was used to getting his way. He didn't like the fact that the Fed was trying to fight inflation by raising rates. Okay, very typical story with presidents and Fed chairs. So the fight started when the Fed ignored the president's demand to leave rates alone. Instead, the Fed hiked rates. LBJ was really, really mad. He summoned Martin to his ranch, where he literally, I think he was recovering from gallbladder surgery or something like that. That's how the story goes. And apparently LBJ berated Martin and even pushed him around, physically shoved him around the president's office. Okay. So there's a story of almost every presidential administration. Clinton famously was really mad that the bond vigilantes are going to take his presidency away if he didn't listen to them. This has been going on for so long.
I think Nixon had an issue with it too.
Nixon had an issue, a huge issue. Yes,
leading up to the election. Yep.
Exactly. So, look, there's always been this battle. Look, I mean, you could talk to some people last year. Why did the Fed cut so aggressively into the election? So this stuff has always been out there. They cut
after the election too.
Yeah. Look, I'm not saying they're right. What I'm saying is that there's always drama around this. There's always there's going to be times when the Fed does not align politically with the president and vice versa. All right. That's how it works. That's way of separation of powers. This just didn't say this is going to translate into something where we turn into Zimbabwe. I don't buy it. I don't buy it for a second. I think this is going to be a distant memory in short order.
I think you could be right there. But speaking of the Fed, regardless of what's going on with the different governors or who's getting blasted on Truth Social and who's not, the general story here is that rates are going to be coming down. I know we've harped on this for the last few episodes. I know we've left out a few articles talking about rates are coming down. You should look for some cash alternatives. But this is just another indicator just showing that rates are almost a certainty that they're coming down in relatively short order. What you're looking at here in the blue line is the federal funds effective rate, and that's just the Fed rate essentially. And the red line, you're looking at the 2-year treasury. Now, the 2-year treasury, as you can see here, tends to precede Fed rate cuts or Fed rate movements. And the reason being is obviously you go 2 years out, the Fed rate that they're setting is on very short-term deposits. The 2 years, obviously a longer term deposit. It's more than a year. So typically you would expect to see the 2-year above the federal funds rate. If they think that the Fed's going to hold rates or even potentially raise rates, you should see the 2-year above the federal funds rate. But what we're seeing right now is a bit of an anomaly. You see the 2 years paying less than the effective funds rate is. What that means is the market is very, very, very sold on the concept that 2 years from now, interest rates will be lower. In fact, if we look at odds of rate cuts in September, the market seems very convinced that the rates will be lower by next month. So the point being is rates are coming down. And what happens to the market when rates come down? The chart you're looking at here is what happens to the S&P 500 when the Fed restarts a rate easing cycle. So the rate easing cycle began last year, as Mike mentioned earlier. The first 50 bip cut right before the election, as well as the 25 basis point cut right after. That started the easing cycle. And now we've seen a pause. We've seen a pause for we're getting close to a year here. And this is showing the results of what happens when they start cutting again. And as you can see at that dashed line there, that's after the first rate cut, after a pause. And the general direction is up and quite violently up. We expect the market to do similar now in terms of level, like how high does it go or how quickly it goes. We can't speak to that, but it'd be hard to believe that rates come down and stocks don't go up.
I think that Bepin, you mentioned this earlier, that we've been talking about this for months about how rates are coming down. I would kind of let's kind of simplify what's really happening here. We did say this going back to, I don't know, maybe June or early July, the last time the Fed did cut, they should have, right? We said, okay, you now have a couple months until you got to start rethinking about your cash position. You got a couple months before you want to start locking in better yields, because we're going into a period most likely that is not going to look like today. When we were saying that back then, you had months. Today, you have weeks. All right. Now, I'm not trying to I'm not trying to nudge anybody too hard here, but if you are sitting in cash and this is something that you realize you don't need to have in cash, you need to come talk to us and do it quickly, because in that 3 weeks?
3 weeks, yep.
3 weeks, rates are coming down. And there's a good chance that it's not going to be one small 25 basis point cut. We could see a full point getting taken out by the end of the year.
Yeah, no, definitely. And I mean, the market really got reassurance there last week on Friday when the Jackson Hole Summit, Powell had a speech. First thing that came out of his mouth was the balance of risk has shifted. Now, that's a little bit of Fed speak. Basically, what he was saying is that the labor market now is starting to become more concerning than inflation is. And what does that mean? That likely opens the door for them to cut. You add in some pressure from the outside world, and I think it's almost a done deal that we'll at least see 25 bips here in a few weeks. Now, I know Mike was talking about cash, but there are some other positions we would recommend you reevaluate. And what you're looking at the screen here is a chart showing the high beta ETF performance since the Liberation Day bottoms of this year versus the low volatility in purple there, basically a flat line. What you're seeing here is growth versus value, essentially. growth stocks being the high beta stocks, value being that purple line there, the low volatility stocks. And what we're recommending at this moment is that obviously growth has been the main driver. It's been for the last 15 years. The Mag 7 are the best stocks, the biggest stocks to be holding right now. We think it might be time to buy the 493, and the 493 is primarily made up of value stocks. And ironically, actually, value, at least our internal value model, is actually beating our growth model this year, but that hasn't been the case around the entire sector. It may be time to reevaluate a little bit of that ag growth position. We've had a very good 3 years here of our aggressive growth model producing double-digit returns. And if you're looking at it right now this year, it's up double digits again. If you've seen a big run up there, it could be a good time to talk to your advisor and look to reevaluate. Now, we're still very bullish on U.S. stocks. We just think it's the other guy's turn. It's finally going to be a time for them to shine versus the constant just Meta, Microsoft, Apple, Google, Amazon. We believe it's time for the rest of the economy and the rest of the stock market to really start taking off here. And rate cuts make a lot of sense for value because guess what? Value stocks pay a nice dividends. It can be almost seen as a yield. So when the market yields, interest rates start coming down, the value of your stock dividend becomes much more valuable to the market. They're willing to bid that up. So it's a very opportune time right now. And as Mike said, it's not a matter of months here. It could be a matter of weeks as we start seeing rates come down. We expect that to be a nice tailwind for value stocks. And lastly, with that, we'd like to thank you for tuning in. We hope you have a wonderful Labor Day weekend. And as always, any questions or if you'd like to reevaluate, feel free to give us a call at any time. Thank you and have a great rest of your day.